A number of stocks have sold off recently in the last year, and because of this, there are a few high quality stocks that are offering what I like to call an accidental high yield. Now, what I mean by this is that there are certain stocks that are rarely this cheap, but when they are, they of course offer a much larger starting dividend yield to investors. Because when it comes to dividend stocks, the cheaper you can get in on the price, the higher the starting yield. Now in this video, we are going to go over 5 different dividend stocks that are all on sale, offer safe dividends, and offer a greater than 6% starting dividend yield. Now stick around because you are going to want to see which stocks these are and exactly what they have to offer. Right up to you, please drop a like in this video and subscribe for more future content like this. So the first accidental high yielder that's been beat up a lot over the last year is none other than ticker symbol VZ, Verizon Communications. Now Verizon was formed in 2000 when telecom giants Bell Atlantic and GTE merged in a $52 billion transaction. But the company's predecessors' roots trace back to the late 19th century when Alexander Graham Bell patented the telephone and founded AT&T. Now Verizon has been beat up pretty bad over the last year or so, and currently down over 13% year to date and over 16% over the last year. Verizon definitely has some issues to worry about, like the lead in the telephone cables, Verizon's massive debt load, but still for some investors that are willing to take the risk and hold on to Verizon long term, this could be a stock to look into. Now with Verizon trading at the range that it's been trading in, Verizon is offering a massive starting dividend yield. To be specific, 7.49% is the forward dividend yield from here. On top of that, Verizon historically has offered some massive dividend growth, and the next quarterly dividend payout should be another sign of that. So for the investors out there that are willing to dip their toes into the telecommunications sector, Verizon is definitely one to look into. The next accidental high yielder that's definitely on sale is the Bank of Nova Scotia, or ticker symbol BNS. Now founded all the way back in 1832 to provide currency for trade transactions, Bank of Nova Scotia is one of Canada's largest and most diversified banks, with over 30% of its revenue derived outside North America. Now, Bank of Nova Scotia is currently trading at $48.14 per share, and even though the overall banking sector throughout the world has not had the best last 12 months, Bank of Nova Scotia is actually green year to date, up almost 1%. But on the max time frame, Bank of Nova Scotia has returned a lot just as far as price return alone, up over 189+%. Now ticker symbol BNS also has some issues ahead, but with the stock offering a trailing 12-month dividend yield of 6.39% and some pretty healthy substantial dividend growth historically, this is definitely another high yielder that has been on my radar over the last few weeks. The next accidental high yielder is none other than WP Carey, or ticker symbol WPC. Now WP Carey was named after its founder and formed in 1973, and of course WPC is a diversified REIT specialized in single-tenant commercial real estate, with over half its properties located in the US and most of the rest found in Northern and Western Europe. Now WPC has been absolutely hammered over the last year, pretty much along with everything else related to real estate because of the massive interest rate hikes that we've been faced over the last 12 months plus. Year to date, WPC is down over 16%, and over 22% in the red in the last year. And because where WP Carey is trading currently and the interest rate environment, this REIT that historically offers consistently maybe 3.5 to 5.5% forward dividend yield is offering investors currently 6.55%, and I've been taking full advantage of this as of recently, buying hundreds of shares personally. Now WP Carey does have a diversified portfolio with a balance between industrial, warehouse, offices, and retail properties, being the key strength of the portfolio. The company has also been focusing on growing its industrial and warehouse divisions, which now makes up of around 51% of the annualized rent base. Looking into some more facts on the WP Carey website, it says large diversified portfolio of high quality real estate. Our asset management teams in the US and Europe are dedicated to proactively managing our portfolio and working with our tenants to ensure they have the real estate they need to meet their evolving business objectives. And some more facts about the company: it currently has 1,446 net leased properties. Now for those that don't know, according to Investopedia, triple net lease, or NNN, which is what it's called a lot of times, is when a lease agreement on a property whereby the tenant or lessee's promises to pay all the expenses of the property, and this includes things like real estate taxes, building insurance, and maintenance. And just a fun fact, triple net leases are one of the most favorable lease types for commercial real estate investors. Now looking into WP Carey's dividend growth, or sort of lack thereof, this REIT doesn't really offer all that much dividend growth, at least it hasn't in the last 5 or 10 years, although there has been some small yet consistent raises in dividends historically. But if you happen to want some exposure to the real estate sector, and if you're interested in investing into REITs, WP Carey is definitely one to look at. And like I said, WP Carey has been on my radar now, and I've definitely personally been investing pretty heavily in WPC. The next accidental high yielder that I've also been buying some shares of as of recently and that you should definitely look into is Pembina Pipeline Corporation, or ticker symbol PBA. Now founded in Alberta's Pembina oil field in 1954, Pembina Pipeline has become a major midstream service provider with a network of oil and gas pipelines, storage facilities, and processing plants located primarily in Western Canada. Now ticker symbol PBA has made a spot in my portfolio for many years now. And with Pembina slowly getting closer and closer to the lower end of the 52-week range, I've been nibbling on some more shares as of recently. Pembina is down around 5.5% year to date and down over 11% over the last year time frame. And because of the sudden drop in price, Pembina is offering a trailing 12-month dividend yield of around 6.23%. Now looking at Pembina's recent dividend payouts, there has been a nice dividend increase over the last few payouts, and although PBA is no longer unfortunately a monthly paid dividend stock, it now offers a quarterly payment. Like I said earlier, it still lands a small portion in my portfolio, and I'm definitely watching to grab some more shares of PBA, especially if it gets closer and closer to a brand new fresh 52-week low. Now the last accidental high yielder that I have been buying some shares of over the last year is none other than Main Street Capital, or ticker symbol MAIN. Now, Main Street Capital was founded in Texas during the mid-1990s. Main Street Capital is a business development company, or BDC, and Main Street Capital is one of the higher quality BDCs in my opinion. Now, Main Street Capital, unlike the rest of the group that we went through in this video, is actually up year to date, up 11.33%. And luckily, I bought a lot of Main Street Capital earlier this year when it was closer to the lower end of the 52-week range. But looking at Main Street Capital on the max time frame, this stock definitely has the potential for some massive price return, at least it has historically. And with where Main Street Capital is currently trading, this monthly paid dividend stock is offering a 6.79% starting forward dividend yield. And like I said a second ago, Main Street Capital does offer a monthly paid dividend, which I absolutely love and which lots of dividend investors love. And even though the stock isn't known for its massive dividend growth, they still have been raising dividends pretty consistently over the last decade or so. So for the investors out there that are looking for a high quality monthly paying dividend stock, definitely dig a little bit deeper into Main Street Capital. And if Main happens to get a little bit closer to the low end of the 52-week range, I will definitely personally be adding some more shares to my portfolio. So there we have it. Those are 5 different dividend stocks that all offer a safe forward dividend and for the most part are offering a higher yield than normal historically. Now the beauty of dividend investing is if you can find the few times in history that you can buy into a high quality dividend stock at a very low price, you can of course lock in a very high starting dividend yield, and with dividend increases over time, you're able to pretty much ride along with the dividend stock into the future and get paid massive cash flow along the way. But now I want to hear from you guys down below across all of your research. What are 3 accidental high yielders that you've been buying as of recently? If you enjoyed this video and you want to see more videos like this in the future, make sure to please drop a like on it and subscribe down below. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.